Hi, my name is Nicole Lord at eXp Realty, and today I have one of my preferred lenders, Ron Valerio with Guaranteed Rate Affinity Mortgage, here to talk with me about the mortgage side of real estate. So we've got some great topics to talk about. We're going to be talking about the interest rates, where they're at this week, because they seem to be fluctuating quite a bit on a weekly basis, it seems like. We're also going to be talking about recession and some helpful insights for buyers in this market. So Ron, I want you to introduce yourself, let our viewers know a little bit about you and your background in the mortgage industry.
Hey, thank you, Nicole, and thank you for inviting me on here. I'm excited to be here with you today. I first of all want to say that Nicole's an absolute superstar. Just her personal touch and her approach with the clients that we've worked with together is just phenomenal to have a professional like you. So thank you so much for your invitation here. Yeah, so as Nicole mentioned, I'm a Vice President of Mortgage Lending with Guaranteed Rate Affinity. I've been in lending since 2001. So I've, 21 years now, which I can do math sometimes, right? But I love the industry that I'm in. I have a diversified background in the industry where I've done a little bit of, I've done operations, I've done underwriting, corporate training, and since 2007, I've been originating. And I'm a resident of obviously Arizona, and I've been here for 18 years and love Arizona and just love the opportunity to help people obtain a home ownership here.
Yeah, absolutely. Ron's been amazing to deal with. Very smooth transaction, the last one that we had dealt with, even though there were some hiccups. So he's definitely somebody to go to. Okay, so like I mentioned earlier, we were talking briefly before we started recording that I give a lot of updates, market updates from the real estate perspective. So I wanted to get Ron back up here and start talking about what the mortgage side looks like, where interest rates are at, because we're hearing all the time, that it's going up and then it's going down. It's kind of fluctuating. So if you can give us a quick update on what you were seeing from your perspective.
Yeah, I mean, we get the media and we feel like the sky is falling when we hear the media itself. We have seen an upward pressure of mortgage rates since the beginning of the year, different movement and backing off of what the Fed has been doing. And a big talk and chatter right now is the Fed fund rate that they're moving actually today. We're recording this on June 15th. And so we've seen some fluctuation on mortgage rates. Now, the most recent movement in the last week is just a lot of the market's reaction to what the Fed is going to do. They're doing everything they can to curb inflation. And by moving up their short-term rates is going to help kind of scale things back on that demand that we all feel very, very, I mean, even at the gas pump and on mortgage rates itself. Although we may see the market's reaction, with what we've seen in the last several days, especially, we've seen a spike in rates. That may just be an overreaction. So it's possible that we're going to see things kind of stable out a bit and start moving, depending on what the Fed does today. But I think they are going to take inflation very seriously, and they're talking about 0.5% or 0.75% on move on rates. And when we talk about the Fed rate, those are your short-term rates, just to differentiate. Mortgage rates are controlled by mortgage-backed securities in the free market. They're not controlled. The Fed does not have direct control of mortgage rates. It's the market's response to and where investors want to put their money, if they want to put them in treasuries and bonds and mortgage-backed securities that help kind of drive the mortgage market itself. So we're in for a ride. That's the thing that's only guaranteed at this. We wish we could predict the future. Definitely wouldn't be sitting here if I could on the market itself. But we're definitely going to still see some volatility and fluctuation moving forward.
Okay. Now, another hot topic that's been coming up is recession. Now, most people think that that's going to equal a housing crash. Can you kind of give your input on that one?
Yeah, great question. Actually, I was on a great call with the CEO and founder of NBS Highway, Barry Habib. And he showed a graph that was showing the correlation between the recessions that we've had historically and the housing market. Arizona is a unique market. Now, it's not across the nation, things can change and pull, but we have a very high demand state. I know things have gone up and sometimes may not feel like that we're affordable as we were before. But could I share my screen?
Absolutely.
Would that be okay? Let me pull up this graph, and I think this would be, let me pull up. So on your question, with regards to recession and the housing market, with where things are gonna, looking to see if we have a recession, will this create a housing crash? In our minds, anybody that's bought a house in the Great Recession and the housing crash of 2008, we still kind of have that very close and don't want that to happen again. But if we look at this, again, this is provided by Barry Habib from MBS Highway, which I'm sure Nicole can provide some links in your presentation here. But if you look at this shows a graph of the housing market through the recessions. The recessions are right here, and we see that through every recession that we've been into, which is the gray, we've seen, now this is 2008, which was a unique circumstance, which we're in completely different circumstances. That's the only time that we've seen a significant drop when we've entered into a recession itself. So I thought this was a great graph that was provided by MBS Highway, because it really puts it in perspective historically trends of how it correlates with a recession and the housing market itself. So it's unlikely we're going to see any major pullbacks. We are going to see some slowdowns, which we need. It's unsustainable to have the appreciation that we've had over the last couple of years, but it's going to be a steady growth in strong markets like Arizona is.
Right. Now, would you say that recessions, normally lowers the interest rates? We start seeing interest rates going down, historically speaking.
Great question. Yeah. So as actually, this is another graph that I pulled from MBS Highway on a presentation that I was on, and this shows the correlation of mortgage rates with recessions. And anytime that we go into recession, what we generally see is mortgage rates pulling back. So I worked with a lot of financial advisors over my years in the industry, and I used to joke that I was the only one happy in the office when I was sitting with and working with financial advisors when the market was pulling back, because investors will pull and put their money into bonds and treasuries like mortgage-backed securities, which will help rates come down. So as we're seeing kind of the spike in rates right now, if things do pull back a bit and we do go into a recession, then it's likely that we may see things kind of tell down and move down on mortgage rates side of it, just based on historical trends that we're seeing here. Now, the definition of a recession is basically if we're seeing 2 consecutive months of negative GDPs. It's the National Bureau of Economic Research that determines for us in the US what an actual recession is, but that's generally what we've seen. So we've seen Q1 as a negative. It's possible that we could be going to that, but it's not the end of the world. It actually may help out stable out markets and help with mortgage rates itself.
Right. And that's what I was hearing, is that they're expecting to announce that Q2 is probably going to be in the negative as well. So going into Q3, they should announce that we are officially in a recession. But like you're mentioning, it does not mean it is a housing crash. We should possibly potentially see interest rates going down for us. And obviously that's going to bring in more buyers. The buyers have already pulled out of the market because of interest rates.
Right.
So yeah, that's very interesting what the history has shown. Now, I think a lot of people like to compare this as 2008, like you're just showing there is a huge difference. Can you kind of enhance on what that difference is now versus 2008?
It's really just supply and demand. In 2008, we had an oversupply of homes. We had aggressive lending products. And that, I mean, just in a nutshell, there was a ton of homes that flooded the market in a short period of time, not enough buyers. And so the only option people had were to foreclose, and banks weren't able to, and investors that backed these loans weren't able to react as quickly. Where right now we have still things are starting to go towards more of a balanced market with supply and demand, which is great for our buyers. Mm-hmm. But there still is a seller's market where there's more buyers than sellers on the market. And lending regulations have changed substantially. There's a lot more responsible lending, and it's extremely, it's two different circumstances. I'd say extremely unlikely that we're going to see any pullbacks in home values, but the mortgage industry is not going to be the leading of any recessions or any housing values.
Yeah, and also there's the homeowners. There's more skin in the game for these buyers. They have more home equity as well.
Right.
That where they're coming in with more cash because of the equity that they've had over the last few years. Also, like you're mentioning, the inventory 2008, I think it was over 9 months of inventory. We just, I think we're at about a month and a half now. We typically, Arizona is typically around 30,000 homes. And 3 to 4 months ago, we were about 4,000 homes. And I just checked yesterday, we're just a little over 12,000 homes. So we're 3 times more right now. So we are getting more options for buyers. But it's, yeah, like you're mentioning, it's just a night and day difference on what 2008 was versus now, what the market was like. So we don't see it. It's not going to be like a 2008 here.
Exactly.
Right.
And like you said, people have equity positions. If unfortunately with things tightening up, and if someone does have to move out of their home, they have a position to sell. Where in 2008, there was 100% financing. There option arm loans. There was a ton of different option loans out there that just were not responsible lending, and people couldn't sell because they didn't have the equity position to even sell the property itself. So, so we're definitely in a different circumstance.
Yeah. So I just think that even with rising interest rates, I don't believe it to destroy the home values at all. We just need a substantially less demand and far more housing supply than we presently have in order for that to turn into a crash. That's what they like to say. Okay, let's jump over to buyers. So obviously we've had a lot of buyers kind of just withdraw from the market because of the interest rates. They're waiting for the interest rates to drop. They believe that the home prices are going to pull back a lot, like 2008. I believe 2008 showed that there was a graph, I think last month, CoreLogic, showing that there was a 19% drop. And I actually just saw on social media the other day that somebody put an announcement, don't buy now, don't buy, we're expecting a 40% drop. I'm like, oh my goodness, I would love to see the stats for that. But that's obviously not going to happen because, like I mentioned, we are just the demand's there, and we have more homes coming to the market. So we're still well below normal levels, but the demand is still there. We're still in the seller's market, but it still looks a whole lot different. So we have these buyers that have withdrawn. The problem is, like we kind of talked about before, is that they're losing out on the appreciation that we're expecting to see over the next 5 to 6 months. The homes are not going to be dropping here. And it's going to cost more to wait than the difference of the interest rates almost every time. So I wanted to see if you can kind of speak to that, the interest rate now versus waiting.
Right. I mean, all of us want to time the market perfectly. And if we can find that friend that knows exactly when to time things, either the stock market or the house market, we'd all be millionaires together, right? But like you said, it's trying to time out as we see rates going up. It does create hesitancy, which, with everything else is moving, is totally understandable itself. Point that I want to point out first is affordability and budget. Where with any clients that we work with, I want to ensure that we're looking at your affordability and making sure that it fits within your budget and it makes financial sense for you. It may be uncomfortable, and I totally get that and respect that, given the way things have moved on us itself. But the great thing about mortgages is, yes, you're getting into a 30-year mortgage, or there's other options that we'll talk about. But you're getting into a long-term loan. But the great thing about mortgages is you can renegotiate your contract down the road. So we have the option to refinance and drop the rates, drop the monthly payments, or put you into a better position where maybe it makes sense to go to a 15-year or a 20-year loan itself. So if we're holding back on rates itself, it's going to be difficult to time the market based on just rates, because we're feeling indications may see that rates may stable out a little bit. They could go back up, and I can't guarantee anything on that side of it. But as long as the loan's affordable for you, that's what we want to make sure that fits within your budget itself. And so then within regards to mortgage rates, if, you know, a year from now or 2 years from now, rates drop, we jump in and we put you into a low cost refinance so that makes financial sense for you at that point, or reassess your financial position, and maybe a 15-year look makes sense for you, as I mentioned earlier. The only thing that's predicted that we've seen in the Arizona market is rents in comparison to mortgages. Rents are going to continue going up. The demand is staying high in that. They haven't built apartment homes in several years. They're drastically trying to do that and build them here so that people can bring rents a little bit more into affordability for those. But with mortgages, you're going to be able to, you're not going to be able to just renegotiate your rent, you know, when rates drop itself. So in comparison, mortgages will still be a stronger financial investment for you in the long term.
Yes, absolutely. And also, you know, like if you get locked in now, you buy a home now, if rates do continue to go up at some point, you know, you're protected. You're now protected from that higher interest rates because you bought when they were at a lower rate. Right. The other thing I was going to kind of bring up is 3 to 4 months ago that they were, like I mentioned, there was 4,000 homes on the market. Now we have more homes available to them. So now the homes are staying on the market a little longer. We're not seeing them going over asking price. So now they're not having to pay more than what they feel like they were worth because they're staying on the market longer. We have the buyers that have pulled out. Experts are still seeing that 4% year over year that's going to be increasing. So they're also going to be, you know, over 5 to 6 years gaining around 26% of home equity. So right now, you know, interest rates may be a little high. It's, you know, but like you're saying, you're locking something in for yourself as rentals are going up even more. So right. Go ahead.
Yeah, right on that. So the market's been really tough for our buyers in the last 2 years, where they just haven't had an option where they take the home that they can get opposed to finding the home that fits their family's needs. Yes. And that's just a tough position for buyers. The market's starting to shift where our buyers are going to have options now. And yes, the payments may be a little bit higher because of these interest rates, but it's the cost of acquisition of getting a home that's going to be more of a home that fits your family or a dream home for you, opposed to this is the only home for sale in the neighborhood that you want to be in. Yes, it doesn't have, you know, all the parameters that you want, but take it or leave it. Which one do you want? So, right. So it's been a shift in the market with, you know, more supply, but rates are pulling that, or have had that upward pressure on us. Mm-hmm. But as you mentioned, Nicole, we're going to have the option. If we look at the historical trends of rates, yes, they'll go up, but then we will see down the road. Now, I can't predict exactly when, but we will see markets and interest rates move, so that will create a refinance opportunity for you in the future.
Now, a lot of buyers feel like they are stuck in that interest rate for the life of the loan. You just mentioned that they're not. How soon after purchasing could they refinance?
Great question. Yeah, generally want to see a 6-month period that you're looking at to refinance a property is a general rule of thumb that they look at. Okay.
Now, is that different with an ARM loan at all?
With refinancing into an ARM loan? No, it'd be the same. Okay. Now, ARM loans are great products in the right circumstance. If someone's looking at a 5 to 7 year period, maybe a 10-1 ARM or a 7-1 ARM loan will make financial sense. A lot of people are hesitant about ARM loans because of 2008 and not understanding or having a professional explain how ARM loans work. But based on the margins of those ARM loans, in the worst case scenario, the amount that you save, even if you enter in the adjustment period, will outlast the fixed period. So it may take, if you're in a 5-year ARM loan, it may be 6 or 7 years before you actually truly break even in comparison to take a 30-year loan itself. Mm-hmm. But you want to look very closely to your financial goals and make sure it fits your budgets. But an ARM loan, especially in a rising rate environment, could be a great option for someone that may be transitioning through jobs or in more of a 5 to 7 year period timeframe that I generally look at with my clients.
Okay. All right. Since we kind of touched this now on ARM loans and different loans, let's go ahead and get on that. subject, because we have buyers that I've been hearing a lot of buyers that have signed on a new build back in November, December, and it's obviously not completed. You know, it's been taking more than 12 months. And now they're starting to see, I might not be able to afford that. Now, is an ARM loan an option? What do you think about options as far as trying to get them back to the affordability of that home?
Yeah, great. I mean, that's been really tough with, you know, with these, just a perfect storm with these builders itself. So yes, an ARM loan may be a great option. Another thing to look at is with Guaranteed Rate Affinity, we offer an extended rate lock program up to a year, where the builders are generally at 90 days, maybe 6 months, where they can lock the loan in. So what that allows us to do is, if we have a rate locked in 180 to 360 days up to a year, we can guarantee affordability for that property that they're in. Where if predicting the market and then rates do jump up to 7% or 8%, that may push some of our buyers out of the market and losing this home that they've been waiting, you know, 9, 12, 14 months for, which is definitely not anything anybody wants to put our buyers into. So
right. And can you speak a little bit more to the rate lock? A lot of people don't realize that they can do that now. Is there fees that are attached to that?
Yes, there's generally an upfront fee to secure that rate. With interest rates, the longer you lock a rate in, the higher the costs that are associated with it, because the bank is pulling those funds and reserving them to that rate. So there is, with Guaranteed Rate Affinity, we have an upfront fee that the client actually pays, but it's applied towards your total closing costs at closing itself. So you're basically putting a deposit to guarantee a rate for a up to a 12-month time frame. So it's a great option, especially if, unfortunately, the builders continue pushing out that closing date and haven't been able to solidify that. So it's more just putting you in a position to guarantee affordability and guarantee the, because by locking that rate in, we go through a full conditional underwriting approval. So it's not just a pre-qualification, the underwriter is fully vetted and approved, and we secure that rate in with that.
Nice. Okay, very good. Now, can you kind of talk to us about where rates are at for conventional FHA, USDA?
Yeah, absolutely. Let me share my screen again real quick. I pulled just historical trends, and of course, interest rates will fluctuate depending on specific circumstances for each client, but this will give us a general trend of mortgage rates. So let me pull this up real quickly here, and then. So right now, and these again, this is generally speaking average rates given the market. So we've seen a shift. We've come across that 6%. Haven't seen that since 2004, 5 time frame. And so, but on a 30-year fix, we're average rate around 6%. 15-year is around, and these are conforming. Conforming lending limits is if you take a loan under 647,200. Or below is our conforming lending limits in Arizona. There are high cost areas, but there's none of those. We have no high cost areas in Arizona. One thing that we see is there's a misconception on jumbos. A lot of people think jumbo rates are higher than conforming. Jumbos recently have been floating about 0.5% below jumbo rates or conforming rates. So if you're right on that edge of 647,200 and you're putting more money down to get below conforming, make sure you speak with your mortgage professional and look at maybe moving that loan balance up a little bit to go through. The only difference with jumbos is their underwritings, they're backed by different investors, more direct private investors. And that's why the rates are lower, but their underwriting guidelines are tighter. So you just want to make sure that you fit within the underwriting guidelines. FHA, we're seeing about 5.676, and USDA is right here, about the same as FHA. 5 point down at the very bottom of this little is a USDA 5.611. FHA and USDA come with additional costs, and so that's why the rates are a little bit lower with guarantee fees and or mortgage insurance. And so they offset the rate by charging more costs. So if you're looking between a conventional and FHA, you just want to do a side-by-side comparison and see which one actually in the long term would make financial sense for you.
Okay. Now, a lot of people think that for conventional, you still need 20% down. Can you?
Yeah, great question. Conventional, we can do as low as 3% down with conventional, 3, 5, 10, up to 20%. The benefit of putting 20% down is you avoid that monthly mortgage insurance. There is circumstances where we can adjust the interest rate to take away that mortgage insurance if the monthly payment is tight on your debt to income. So you can adjust the rate higher and take on lender paid mortgage insurance, which is just included in the interest rate itself. But definitely, if you don't need to save up 20% to purchase a home, you can do as low as 3% on a conforming loan balance.
Okay.
And even jumbo, we do have some investors that will do 10 and 5% down on a jumbo investor. A lot of people still have that conception too, that you need the 20% down under those. And with home prices moving up as they have in a lot of areas in Arizona, we are being pushed closer and closer to that jumbo lending limits and much more in that game now.
Yeah, for sure. Okay, now let's talk about VA loans. That's a great loan, great program for our veterans. If you can kind of talk about, I know that rate happens to be the lowest out of all of them. Am I correct?
Yeah, absolutely. So the VA rates are phenomenal. It's VA programs are just amazing for our veterans, as they deserve. They can do 100% financing, yes, I mean, VA is just a great option for our service members, active duty or retired. And we just go through and verify what their benefits are. And if they've used their benefits in the past or have any VA loans outstanding at this time. But the rates in VAs are phenomenal. And the great thing about VAs is there's no mortgage insurance. So it keeps those payment levels lower. So even though you're putting that 100% down, you don't have that monthly mortgage insurance. That would move up the monthly payment itself.
Right. And one of the things that you do need is that certificate of eligibility. Now, if they don't have it, are you able to get it for them, or how do they go about it?
So we do have some technology tools that pulls the different eligibilities for our service managers, but they can go online and obtain it fairly easily. They made it a lot easier than in the past. In the past, if they lost that VA, it made it tough to try to find it in a waiting time frame. But yes, it is. There is actually some technology tools that allow us to verify the eligibility of a veteran, which is awesome.
Okay, very good. The other thing I want to touch base on is I actually have a self-employed buyer that is from out of state. Now, what do you need from a self-employed buyer that even lives in Arizona versus out of state? What's the difference there? What are you looking for?
What we're looking at is a challenge that we run into sometimes is what they're reporting as taxable income. The benefit being self-employed is you have the ability of your expenses to write those off on your tax returns. And that's great because that lowers your total bottom line and what you're paying in taxes, as it should. But in the lending side of the world, it makes it tough because what we can use for qualified income. So generally what we're seeing is a 2-year history of self-employed income. Although if they have an operating business for over 5 years, then Freddie Mac does allow only 1 year worth of tax returns. Sometimes that helps out, especially with COVID. We've seen some businesses fluctuate, and we can pull out that 2020 tax return and we could use 2021. So if we're able to fit them into Freddie Mac as the investor itself. So generally what we're looking at is that 2-year history, is generally speaking. Now, if you're moving out of state into Arizona, what the underwriters want to see is stability and what type of business you're running. So they're going to ask a lot more questions to see, are you going to be able to operate your business out of state, or is it a business that can be transferred here? How does this work? It creates more questions. We're underwriting the loan, and the underwriters, their approach on it is to show the predictability of payment history through a 30-year mortgage. And so if we don't show the stability of a business, it's going to be hard to write a mortgage or get an underwriter to write off on it, saying that they were running a business that was specific to Los Angeles, that it's not going to be operational here in Arizona. Then it's going to be tough to find financing on that side of it. Now there are other programs, and we're going to run to that stability with any of the investors, but we do have programs where maybe you aren't showing as much income on your tax returns. There are broker options. There is bank statement loans where we can show a 12 or 20-month bank statement history of deposits from your personal deposits and or your business deposits itself. And we can use that as qualified income under some different broker options that we can use. So don't throw your hands up in the air if you're like, oh, I've written off all my taxes and I have zero thrown over. There are some lending options that will allow us to use actual cash deposits into personal and or business bank statements. Now with those programs, it is a higher risk loan, so your rates are going to be higher on that. But any of those broker options, we want to look at an exit strategy and provide, okay, well, this will be your acquisition of getting into the property, but what's our plan of action over the next 2 years to get you to more conforming loan and get you out of that loan to that higher interest rate loan. So I always try to look at an exit strategy for my clients if we go to the broker option.
Okay. Now, as far as the line of work, now, are you talking about like if there's a contractor that has been, he's has a contract with another vendor, that would be their work would kind of transfer from state to state. They can go different ways and actually can provide you a contract showing that they're going to be working for this amount of time for this project versus let's say a car detailing place or even a hairdresser that's doing it out of home. Would that be the difference that you're trying to look at as far as a self?
Yeah, absolutely. So say if you have a clientele base with a hairdresser that lives in another state, she's going to have to build up her clientele base here in Arizona before we can show the stability of her owner and operating a business here. Where if we have a contractor that he picks up big contracts and has one to several year projects, and he has a historical trend of doing those projects, even if it's within a specific state and he picked up, that is his motivation to move to Arizona. I think as long as we put together a circumstance that makes sense to the underwriters, that's something that we can definitely approach.
Okay, that makes sense. All righty. So as we kind of close this up, I guess it's not easy to buy a home right now, but it is the smartest investment. So are you kind of agreeing that they're possibly going to be announcing that within this next quarter?
With regards to the recession?
The recession, yeah.
Indications on the different thing I've been a part, it appears that we're going that direction.
Yeah.
You'll see different, depending on the media outlet that you look at, you'll have different opinions, but it appears that we're going that direction itself. But as we mentioned earlier, I know recession has a negative connotation, but I think that actually will help curb back some of these prices that we have. The Fed needs to help bring back inflation, and we all feel it at the pump. And a cost of everything. And so that could help bring down rates. We're seeing inventory increase. I think it's going to be great for our housing market side of things. Yeah.
So I think that homeowners, you definitely want to be a homeowner before the recession hits because of the supply will go back down if the interest rates drop, because obviously more buyers are going to be jumping back in. They're seeing the interest rates going back down. And then the home values will just continue to increase and possibly get back into the same scenario about overpaying for a home. So buy property and don't wait to buy property. For sure. Right. Now, I want you to also I've had a couple of buyers that went online to get their pre-approval. So it's on, web-based versus going to a bank or a mortgage broker. So if you can kind of give us what the difference is between going to a banker versus a mortgage broker and why it's kind of be best to go to somebody locally.
Yeah, absolutely. It's really just accessibility is the main thing. And I'll speak personally on it itself. With all my clients, I provide a personalized touch and I make myself accessible as much as possible. In return calls, with a bank, a lot of times they are limited to not only the products that they have, but their accessibility and responsiveness. And in a competitive market, you need to have all your partners that can be there and available for you, provide the answers, the resources, and have the tools to allow you to be successful and to win an offer against other offers themselves. I think the main difference that we have between banks is, as I mentioned, is product availability, where banks have specific programs that they like and that's what they're going to take. And not all of us fit in those programs itself. And so we're on my side of it, we're going to have a lot more options. And if we can't fit in one product, we'll find a solution for you and make sure that it's communicated well and that, you know, we're able to put you in a program that makes financial sense for you.
Yeah, and I can attest that Ron has been very responsive throughout. If he doesn't, he doesn't pick up the call right away, he's calling you right back very, very soon after that. So he does, and he does go through the extra steps. You know, once you get a contract or you submit an offer, he makes that extra call to speak to the listing agent to say, hey, what kind of loan you have, and just get, you know, just to reassure her that you are in an excellent position to purchase. So that is a great another point that Ron adds to the mix and to the deal. So I do appreciate that, Ron.
Yeah, thank you. It's just, we're gonna do everything we can to help our buyers stick out, and that's we'll do everything we can to make you know, it's a tough market, and just getting buyers to win those offers for sure.
Yes. So can you let us know how we can get in touch with you?
Yeah. So again, I'm Guaranteed Rate Affinity. I'm located out of Mesa, and but of course, do loans all across Arizona. My direct phone number is 480-710-7395, or you can email me at ron.valerio, V as in Victor, ALERIO @grarate.com. And
perfect. I will also add your contact information below this video, but we're going to be posting this and hopefully have you back so we can kind of address other issues and sell it from a seller's perspective. Also just kind of get an update from you on what the interest rates are doing, because they are changing very quickly.
Well, hold on.
I know, fasten your seatbelts. But if you guys have any questions, any kind of comments, any topics you want us to cover, please do send Ron or myself a message. You can write a message below this video, and we will hopefully just be able to address those messages in the future videos. All right, thank you so much, Ron.
Well, thank you so much, Nicole. A pleasure. I work with you, and as mentioned at the beginning of the call, Nicole is an absolute superstar as an agent, very personable, and I know that she just does an amazing job. And just a pleasure, and thank you for your opportunity to assist you and your clients.
No, thank you so much. Bye-bye.